Everyone cheers when rates fall. Meanwhile, the top 1% quietly get ready for the biggest wealth transfer of 2026, from savers to lenders. That's not a typo. I pulled current high-yield savings APYs and compared them to real consumer APRs, and the spread still siphons your cash even as headlines celebrate relief. Here's the thing. Your cash feels safe because the APY on the app looks decent, but the illusion hides tier limits and timing games that reduce what you actually earn. If you've got debt, that same bank's APR barely budges. Your money is being extracted on both sides. In the next few minutes, I'll show you how banks do it, the silent fee you're paying without seeing it, and the bank arbitrage you can flip in your favor this week. Ignore this, and your 2026 cash flow quietly loses to inflation and sticky debt rates, while you think you're doing the safe thing. Rate cuts hit what banks pay you first. Deposits reprice fast, but the rates you pay on debt, they're sticky in practice. Savings yields compress quickly, credit APRs drift down slower, if at all, and lenders protect their markup. That spread erodes your net worth every single month. The emotional trap is feeling safer while your purchasing power slides. If your account earns under inflation, say you're stuck at 0.4 to 1, you're locking in a guaranteed loss when prices run closer to 2 to 3%. Meanwhile, mortgages still hover near the 6% range and credit cards sit around the low 20s. Same pattern across mortgages, cards, and auto loans. The bank's margin survives, yours doesn't. Let me break down what's happening behind the scenes. The spread is the core mechanic. Even with online banks paying 4 to 5% on the high end, credit card APRs average roughly 21 to 24% for active revolvers, and mortgage rates still live near multi-year highs. Banks pay less on deposits and keep loan yields elevated. That's the arbitrage. But here's where it gets really sneaky. Tiered APYs, you'll see 5%, but it's only on the first $1,000. Real balances fall to lower tiers around 4.2% or 4.3%, and traditional banks still sit near 0.39 to 0.6%. Inflation adds a second leak. If CPI runs 2.5 to 3%, any account under that is a guaranteed loss in real terms. Meanwhile, media coverage focuses on cheaper loans, so people celebrate and keep balances. Behavior lags policy. Lenders rely on it. The result? Your savings yield drops fast, your debt rate barely moves, and the gap quietly drains your wealth. Now, once you see the mechanism, you can reverse it by sequencing cash and debt correctly and by exploiting the same timing advantage the banks use against you. Here's the shortcut nobody teaches. Sequence beats hustle. First, set a liquidity floor. 1 to 3 months of essential expenses in a top-tier HISA paying around 4.3 to 5%. That protects you from surprise bills so you don't swipe a 21% card. Next, attack anything with an APR higher than your HISA APY. If your savings earns 4 and 5% and your card costs 22%, every extra dollar earns an instant, risk-free 17.5% by killing that balance. Use the Avalanche. List debts by APR, automate extra principal to the highest, and pay minimums on the rest. Now use timing. Rate shop monthly because banks lag when cutting deposit rates. Move idle cash to the best net yield after accounting for tiers and caps. Avoid two traps: hoarding cash in sub 1% accounts and falling for teaser APYs limited to small balances. Quick win. In the next 24 hours, move your emergency fund from any account under 3% into a real HISA in the 4.3 to 5% range. That single move plugs the biggest hole while you set up the Avalanche. Once you've got a real floor, debt costs fall, and cash yield rises, your retention graph goes flat. You keep more of each paycheck. Give yourself 12 weeks. Your high APR balances shrink, idle cash earns above inflation, and you're no longer paying the silent fee. Then stack tax tactics on top, timing deductions and moving high-yield interest into sheltered buckets where it makes sense. That's when the spread flips permanently. Let's talk about the ripple effect. The headline says the Fed's easing, but your household isn't the Fed. Banks rewrite deposit rates almost instantly using internal pricing algorithms tied to funding costs. Meanwhile, consumer rates, especially unsecured credit like cards, come down slower. Why? Issuers anchor to prime plus a markup, and that markup is their margin. So yes, prime moves drop within a billing cycle, but the plus doesn't shrink much. Mortgages tell a different story. They track the 10-year treasury more than the overnight rate, and spreads over treasuries widen or narrow based on investor appetite and risk. Even with easing projections, fixed mortgage rates are still around the mid-6 in many cases. A quarter-point Fed move might only mean a modest shift on a 30-year quote. Meanwhile, your bank can change your savings yield tomorrow morning with a single system update. Here's the part that should make you question everything. If your savings sits at 0.39% to 0.6%, that's the national average at big banks, you're earning almost nothing. Top APYs hover around 4 to 5% from efficient online players, but many flash a 5% headline only on the first $1,000, then drop you to lower tiers around 4.2 to 4.35% for the balance. The advertised number isn't the yield on your real balance. It's a billboard. Credit cards? New offers cluster near the mid-23s. Existing accounts average about 21% and change, and for people actually accruing interest, it's closer to the low 22s. That's not a typo. Even after months of declines from the 2024 peak, we're still talking low 20s. So you've got a world where your cash tops out at 5% with conditions, and your revolving debt drains at 21% to 24%. The gap is the problem. Think of your finances like a bucket. When your cash yield is below inflation, there's a small hole. When you carry high APR debt, someone installed a fire hose out of the side. Fed cuts might make the hole slightly smaller, but the fire hose is still on. Winners are institutions that fund cheaply and lend dear. Losers are households that keep balances while celebrating cheaper loans. Let me explain why the lag exists. Banks manage net interest margin. They'll compress deposit rates first because it's easy and low risk. Loan repricing is slower because it hits revenue. Add in risk-based pricing, delinquencies, charge-offs, and capital rules, and issuers keep their markup. So the spread survives, and unless you actively move your cash and attack high APRs, your money subsidizes that spread. Here's the part nobody says out loud. If you're earning 0.4% on savings while paying 21% on a card, you've created a private 20% tax on your own cash flow. That's not a typo. It sounds impossible, but I see it all the time. The absurdity of this arrangement is that you can fix it in days, yet most people tolerate it for years because the interface shows a friendly APY badge and a green check mark on-time payment. Let me break down the machinery. Tiered APYs are behavioral finance wrapped in fine print. You'll see 5%, but it's only on the first tiny slice, often $1,000. The next tier drops you to something like 4.2 to 4.35%, and sometimes there's an even lower tier above a larger balance cap. That headline exists to get you in the door and keep you there. Once your cash parks, inertia does the rest. Meanwhile, credit card APRs are prime plus a spread that issuers protect. Even as the Fed trims, the plus stays fat. Timing is the other lever. Deposit rates are easy to cut. One system update and your yield falls tomorrow. Loan repricing, that hits revenue, so it moves slowly or not at all. Variable cards will pass through prime moves within a cycle, but the markup barely flinches. Mortgages tied to the 10-year treasury need broader market appetite to really budge. Bottom line, banks compress what they pay you immediately and defend what you pay them as long as possible. Now the fee you don't see, inflation minus APY. If inflation runs roughly 2%, 3% and your account earns less, that gap is a guaranteed haircut on purchasing power. It's not a statement line item, but it's real. Keep sub 1% cash for a year and you've quietly lost ground even before we talk about debt interest. Let's ground this with a simple scenario. You keep a $5,000 emergency fund at 0.4%. That pays about $20 a year. Move the same $5,000 to a 4% HISA and you're near $225. That's a $205 swing for the same cash, zero extra risk. Now look at the other side. You're carrying a $7,000 card balance at 23%. That costs roughly $1,610 a year in interest if you revolve. Combine the two and your net carry cost is brutal. You're earning $20 on savings while hemorrhaging over $1,000 on debt. Shift the cash to a real HISA and you still bleed unless you attack the card. The fix is sequencing. Keep a minimal cash floor, then throw every extra dollar at the highest APR. Here's the belief breaker. More budgeting hacks or no latte discipline won't close this spread. Psychology does. Banks design products to anchor you, teaser yields, round number credit limits, reward points, so you feel progress while the math extracts value. The thing most people miss is that the first decision isn't save more or pay more, it's where does the next dollar earn the highest certain return. If your HISA is 4.3% and your card is 22%, that dollar earns 17.7% risk-free by killing debt. Nothing in the stock market guarantees that. There's also the regulatory backdrop propping up fat spreads. Post-crisis rules make bank balance sheets more conservative, so they optimize net interest margin, not your yield. That means cutting deposit costs first and guarding loan pricing with risk-based markups tied to delinquencies and charge-offs. It comes down to this. Institutions monetize your inertia. They win when you leave cash in average accounts and carry balances just for the points. So here's the one decision that flips the spread this week. Compute your APR minus APY for every dollar. If your highest APR is 21% and your best APY is 4.5%, every dollar above your emergency floor goes to the 21% balance until that gap is zero. Then, and only then, do you optimize yield, tier aware, cap aware, and willing to move banks when rates shift. Once you do that, the arbitrage stops working against you and starts working for you. Once you see the spread, the fix is a system, not a sprint. Sequence is everything. Liquidity floor, high APR attack, yield optimization, refinance scan, in that order. Miss the order and you'll feel busy, but stay stuck. Start with the liquidity floor. 1 to 3 months of essential expenses, not your full lifestyle. If your baseline costs are $2,500 a month, your floor is $2,500 to $7,500. Why the range? Stable W-2 income with strong job security leans closer to 1 month. Variable income, sales, freelancing, seasonal pushes toward 3 months, sometimes 4. The goal is simple. One surprise bill doesn't force you to swipe a 20% card and blow up the plan. Now the attack, use the debt avalanche, but make it smarter. Target APR minus APY. If your best HISA pays 4.4% and your card is 22%, the spread is 17.6%. That's your priority. Automate minimums on everything, then set an automatic extra payment on the highest spread balance the day after each paycheck hits. Automation beats motivation. Every time a balance falls below the next APR on your list, roll the extra to the next target. Don't pause, don't celebrate with a purchase. Keep compounding the payment. Yield optimization comes after the attack is running. Rotate into top HISAs, but be tier aware. If a bank pays 5% on the first 1,000 and 4.25% above that, park exactly $1,000 there and move the rest to a no-games account at 4.35% to 4.5%. If you've cleared high APR debt and want to lock portions of your floor for a known period, a short CD ladder can work, but only if rates are competitive and you won't need the cash before maturity. Most people overcomplicate this. 2 or 3 accounts are enough. Primary HISA, secondary for tier arbitrage, and checking for bills. Variable rate watch matters if you still carry balances. Prime adjustments hit card rates within 1 to 2 billing cycles. That's fast enough that you shouldn't assume relief is coming. Balance transfers can be a tool, not a lifestyle. Use them sparingly. Only when the promo period is long, the fee is low enough to still beat your current APR, and you've automated a payoff that ends before the promo ends. If you move a balance without a payoff plan, you've just added paperwork. Now, mortgages. Small rate cuts on a 30-year fixed save modestly. A quarter point on $300,000 is roughly $50 a month. That's not nothing, but it's not worth thousands in closing costs unless your break-even is under 24 months and you're confident you'll stay beyond that point. Run the math. Total closing costs divided by monthly savings equals months to break even. If it's over 2 years, or you might move, pass and focus on high APR wins. Let's talk mistakes that quietly blow up progress. Chasing points while carrying balances. If your rewards card costs 22% and pays 2% back, you're trading dollars for pennies. Savings inertia at big banks, leaving your cash at 0.4% because it's simple, is a silent tax. And the minimum payment trap, paying only what the statement suggests, maximizes the bank's profit, not your outcome. Fix all three with automation and calendar discipline. Here are the quick wins that make this real in 24 hours. Open a top-tier HISA. Move your existing emergency cash out of anything under 3% into 4.3 to 5%, checking tiers and caps. Set autopay above the minimum on every debt. Pick a flat number that hurts a little and schedule it the day after payday. Then put a recurring monthly reminder to check HISA APY, credit card APR, and any refinance quotes that could beat your current terms with a sub-24-month break-even. Once this machine runs, project the next 90 days. Estimate interest you'll save as each balance drops. Decide which month you'll cross the line where your highest APR falls below your HISA APY. That's your spread flip date. When you hit it, redirect the freed up payment to either accelerate the next balance or, if toxic debt is gone, to build cash to the top of your floor and then toward investments. And when tax season hits, stack timing so interest you earn is sheltered where it can be. More on that in part 2. Step 1. Move your emergency cash to a real HISA paying 4.3% 5%. Verify tiers and caps so your average balance earns the headline rate, not just the first $1,000. Step 2. List every debt with APRs. Any APR above your HISA's APY gets Avalanche priority. Automate extra principal on the highest APR the day after payday. Step 3. Run a monthly rate audit. HISA yield, card APRs, and refi quotes. If a refinance's break-even is under 24 months, consider it. Otherwise, keep attacking high APRs. Do this, and you reverse the spread within a billing cycle. By week 12, idle cash earns, toxic debt shrinks, and inflation's silent fee is muted. The takeaway is simple. You stop the 2026 wealth drain by controlling sequence, cash floor, high APR attack, then yield, not by trusting headlines. Here's your CTA. In the next 24 hours, move your emergency fund to a 4.3 to 5% HISA and run a 30-minute APR audit. Comment the spread you just flipped. Subscribe for part 2, where I'll stack tax arbitrage on this system and queue up my video on low-rate retirement tactics next.